Now we are going to look at the current tax computation. This is such a vital part of all your deferred and current tax workings that you need to concentrate and get this right. So just before we get into too much of the detail, what's the point of the current tax comp? Well, the current tax comp takes us from profit before tax, which is an accounting concept, to the taxable income on which we will calculate the current tax. So you will have to do a couple of workings to reverse out some of the non-deductible, non-taxable type of accounting expenses and income, account for some of the movements in temporary differences, etc. And you will land up with taxable income. You will then take that taxable income and you will multiply it by the tax rate, and that will give me my current tax expense. From there you will have enough information to pass your first tax journal, namely the current tax journal. Current tax journal, you will start off by debiting the current tax expense. Please note I have marked that off as a profit and loss account, and you will take your current tax expense and put that into the debit of the journal. The credit side of the journal, well, that will be your current tax liability, the current tax payable, which is owing to the tax authority. Great, big picture in mind. Let's have a look at a basic format. Now this format, please, I've ignored any effects of capital gains. We will deal with that in a future lecture in a more complex topic. Okay, so starting off, as we said now, get your accounting profit before tax. That must match up to your statements of profit and loss and OCI. Then I need you to reverse out first what we call the permanent differences. You will have non-taxable incomes, items such as dividends received, which are not taxed as normal current tax, fines, etc., will be non-deductible expenses. Okay, so those are what we call permanent or exempt differences, items which are in accounting income or expenses that will never qualify to be a deduction for tax purposes or be included in taxable income for tax purposes. I'm also going to ask you next to remove out your foreign income, because remember this is our local current tax computation. Foreign income must be removed. You then land up with a total. After that little total, you will then need to look at your movements in temporary differences, all the things that give rise to deferred tax. And here you will reverse out your accounting treatment for items such as depreciation, and then replace them with the tax treatment, such as the wear and tear or capital allowances. Okay. After that, you will land up with either a taxable or deductible temporary difference movement, and the next step is to have a total. It's very easy if there is a positive here. So let's say if you have a taxable income in that stage, you could go straight down and classify that as taxable income. But in the scenario where you have a negative balance at this point, or negative figure, means you've got a loss for tax purposes. Okay. You also need to take into account any assessed losses brought forward from prior years. So if until last year you've been running at a tax loss, the tax authorities say carry those losses forward to the following year in order to reduce taxable income. So prior years tax losses get brought forward to this year, and if they were existing, then you will have a deduction this year. Okay. So at this stage, if you still have a tax loss, then what you need to do is you carry that tax loss forward. And that is our assessed tax loss carried forward in the current year, and that will take us to taxable income of 0. So the concept here is, with assessed losses, which we will deal with in detail later, you cannot have a negative taxable income. Okay? Because the tax authority will not pay you money back. What do you do? Tax losses get carried forward. We will deal with the accounting journals, etc. in the advanced topics later on. Please, the big picture here is profit before tax needs to be converted into taxable income. Once you have your taxable income, you will then calculate your current tax expense by taking that figure of taxable income, timesing it by the tax rate, which currently we'll say is 28%, and that will be your current tax expense. Learn this format, make sure you understand it. You have to be able to apply this properly going forward from now on. Thank you.